What's going on, guys? Welcome back to the channel, and in today's video I'm so excited to share with you how you should invest your $1,200 stimulus check into startups. In this video we're briefly going to overview what the stimulus check is, how you can invest in public versus private companies, and hopefully by the end of the video you'll understand the benefits of investing in startup companies. At the end of the video I'm also going to share a few different resources on how you can find some of the hottest and most investable startups on the market. If you haven't already checked out some of the other videos I've done on how and why you should invest in startup companies, a beginner guide to investing in startups, make sure you check them out, linked in the description below. But in this video, we're gonna focus on that stimulus check. I'm sharing my perspective as an entrepreneur and an investor. If you're new to the channel, welcome. My name is Ksebati. I'm the co-founder and CEO of MySwimPro. And over the last 5 years or so, we've built MySwimPro to be a global technology and media company with a distributed team that spans over 10 time zones. The application was named by Apple as the best app of the year. We've raised about $1 million in outside capital. We're doing over 7 figures in revenue. And on this channel, I talk about entrepreneurship, building startups, investing in startups. So if that sounds interesting, make sure you're subscribed to the channel, like this video, and let me know in the comments how you're gonna be investing that stimulus check. So let's get right into the video. What is the $1,200 stimulus check? Basically, this is a tax-free payment to Americans who make under $75,000. Now, of course, there is a provision at up to $100,000. You actually get a decreasing amount. The additional $100 you make in your salary is a $5 deduction from that, and over $99,000, you're not going to get any of this. It is essentially free money for the American citizens. I know a lot of other countries have done this. In the United States, it was through the CARES Act and also through the HEALS Act. Most currently, in the middle of 2020, there's a global pandemic, and these funds are really designed to help people who are out of work, who are unable to go to work, and to help stimulate the economy, hence the name stimulus. A lot of people are wondering, what should they do with this $1,200? A lot of people are unaffected in a lot of ways. I know a lot of you are struggling through this pandemic, but some of you might be thinking, what do I do with this extra $1,200 or $2,400 that has just come in from the government that is not even taxed? Where will you see the highest return on investment? That is really the question you should be asking yourself. Not necessarily where to invest it, but where will you see the highest return on investment? Where can you put your money to work? You want your money to make you money. And ideally, you're not just gonna go and splurge on a bunch of new material things. You're gonna actually invest it into something that is gonna have a positive return on investment. And truly, the number one place you should do this is the investment in yourself. You need to invest in yourself. What does that mean specifically? It means investing in educating yourself. Maybe that means signing up for a course. Maybe that means taking classes, getting some sort of a certification that will allow you to get to the next level, whether that's through income or personal goals that you have. Invest in yourself. That could mean starting a business. Maybe you're looking for that little bit of capital. With a few $100s, you can go a long way. And the long-term potential, the return on that investment in the long run in investing in your business can be way greater than any other investment vehicle that you can put that money to work. So you can either invest in your education, start a business, or pay off any high interest debt. So if you have a lot of debt to your name and it's high interest and it's higher than anywhere from 4 or 5%, you gotta pay that off. That is actually the highest return on your investment because that is just a drag. You don't wanna be paying interest on anything. And if you are in any of situations like that, make sure you pay off your interest. But I truly believe that you can invest in yourself. If you are thinking, well, that's great and all, but I feel confident with my education, I don't really want to start a business, and I don't have any debt, so how do I actually invest? Do I just go put it in a Robinhood account or put it in an index fund or something like that? You could do that, and there's a few reasons why investing in public companies is different than investing in private companies. And the biggest difference is obviously in the scale of the business that you're investing in. From a financial perspective, obviously the ROI potential is completely different. When you invest in a publicly traded company or an index fund, your chances of the money going to completely zero is very, very low. It's unlikely that if you invest in the index fund, unless you think the entire economy is just going to completely crumble, it's highly unlikely that your investment will go to zero. If you invest in a private startup company, that is a real possibility. If you invest in one single company, there is a much higher likelihood that company fails, goes under, that investment goes to zero. On the flip side, your potential return in an investment in a public company is actually somewhat limited. Sure, you can be one of the early investors in Amazon or Tesla or one of these companies that has seen massive growth, a massive growth stock. The chances of hitting that are less likely, but the chances of having a extremely high return on investment, we're talking 1,000x return over 10 years, 10,000x return. If you're one of the angel investors in Amazon, you had like a 70,000x return on investment, which actually sounds completely mind-blowing. If you invested, I believe, $50,000 in the first round of Amazon, that investment would be worth like $3 billion right now, right? So you can't hit that in the public market. You're not going to 70,000x return. You can definitely get some 10x players, some 20x players over the long run. But when you invest in a startup, you have the potential to see 1,000 times return on your investment. On the flip side, it can be zero. So it's something to keep in mind. Also, the business model is already well established in the public company. In a private company, they're still kind of figuring it out. And that's why the risk profile is much higher in a startup. And obviously, the way you analyze the investment decision is completely different. When you look at a public company, you can look at forward PE, trailing PE. You have quarterly earnings. You have a track record of 2, 3, 5, 10 years where the company is publicly operating that you can look at and believe in this company for the long run. When you're looking at a startup, you're evaluating a lot differently. So if you're interested in how you can do that evaluation, again, make sure you check out some of those links where I talked about investing in startups and some different things and evaluation criteria to look at. And obviously, there is a different timing in the public versus private market. So when you invest in a public company, you can invest pretty much at any time you want, and you can pull your money out at any time you want. Obviously, there's within trading hours, but you can do that all year round. When you invest in a private company, there are normally only windows of opportunity to invest in these companies. And when you invest in a startup, you are investing for the long haul. It's not I invested $100, $10,000, $200,000, and then you can just pull your money out the next day regardless of the valuation, whether it went up or it went down. The value of your shares are pretty much locked in when you invest, and you pretty much only see a return in an acquisition, initial public offering, M&A activity, private equity. Again, I talk about these things in that investment video. And also the risk level we talked about is completely different. Another thing that's not listed here is who can invest in these private companies. Depending on the stage of the company and how they're raising money, there's actually a restriction on who can invest in companies. We'll talk about that and where to find these startups in just a second. But in a public company, you can pretty much invest regardless of your income level. If you have $1,200, you can go and put that $1,200 to work immediately in a publicly traded company, as long as you're an adult and you can do that. Let's talk about why you should invest in startups. I mentioned it, but it's the ROI potential. The return on investment is significantly higher in a startup company because it's early stage. You're investing at a $5 million valuation, a $10 million valuation. And if that $10 million valuation company becomes a $10 billion valuation company, you just added a few zeros onto your investment. So that potential is a lot harder to come by. It's a lot less likely to see that than in a public company, but the potential is there. Now, obviously, valuation is important in a public investment company. You don't want to invest at full price. You want to invest when the market's low. And in today's climate, you could say the valuations in the public market are very, very rich. It's kind of hard to find a deal out there. When you're investing in a startup, the valuation is important, but it's not really a determining factor necessarily, and you're not trying to time the market. So an investment will open up in a startup for only a limited window of time, and you either like the investment terms or you don't. It's not a matter of the public market and just waiting for a good time to buy in. You can't really do that in a startup. So when the public market is trading at a very rich valuation, forward PEs of 5,000, 10,000, who knows what you're looking at, these don't really seem as attractive investment opportunities because your return on that investment is much lower in theory. And so when you're looking at a startup, you can be less relevant on what the public market is doing, and you can evaluate the public and private market completely separately. And that is an easy reason to get into startups, just because you don't have to worry about, am I getting in at a good deal? Because ideally, you're investing in the company to 5x, 10x, or 100x over the next 5 to 10 years. And a third reason, and this may not be relevant from a financial perspective for you personally, but it's really a more immediate impact on the economy. So if you're passionate about helping entrepreneurs and startups and people who are building companies from the ground up, you can get in at the ground level and you can really have a more immediate impact. If you go and buy Apple stock, Apple is going to do fine whether you invest in them or not. Your $100, $1,000, or even 100,000, heck, even $1 million investment in Apple is going to do absolutely nothing to their bottom line, and it's not really going to help move the business forward. If you invest $1,000, $10,000, or $100,000 in a startup, it can actually do some significant moving the needle, and you can't really do that kind of impact in a publicly traded company. So where do you find these startups? Hopefully you're at least interested in thinking about, yeah, maybe I should consider investing in a startup, and you've already invested in yourself, and you've got this free money in the stimulus package. So how do I find these startups? So there's three main areas. There's professional groups, and these are both in person and online, where you can get access. Traditionally, professional groups and startup events, these are angel groups in your local community. There's some of these online. Now these are only for professional investors. These are accredited investors. You make over $200,000 per year, or you have a net worth over $1 million as defined by the SEC, Security and Exchange Commission. Now, you might be wondering, well, someone who makes over 200 grand a year is not going to be receiving a stimulus check. And so for these groups and these private companies, they are not going to be accessible unless they are doing something called equity crowdfunding, or they are raising capital online through one of these open public offerings. And you can find these through websites like AngelList, Seed Invest, WeFunder, Republic. I've actually invested through a number of these different platforms, and I made an investment video on why and how I found these companies and why I invested in them. And you can get my analysis in those videos linked in the description below. You can also learn more about each of these and how you can find startups. You can invest on Republic, for example, for as little as $10. So if you have $1,200, you can invest 120 different startups. Now, most of them have a higher minimum than $10, but just to show you an example of how early you can get in the door, WeFunder is a platform that I use for my company, and we raise over $500,000. I did a video on that. If you're interested in learning how we raise over $500,000 through equity crowdfunding on WeFunder, check it out, linked in the description below. But these platforms allow anyone literally to invest in startup companies, and you can go through and learn a lot about the company and see if you want to make that investment. Now here's a cool return on investment example comparing investing in a startup and investing in a public market account. So if you invest $100 in 24 different startups, so I'm taking the $1,200 stimulus check, I'm multiplying it by 2 because 2 have been sent out, and if you had $2,400, you invest $100 in 24 different companies over the next 10 years. By 2030, here is a hypothetical scenario, and disclaimer, I am not your financial advisor, so always do your due diligence. Let's say 50% of these companies completely fail and your $100 investment goes to absolutely zero. So 12 of them, your investment goes to zero. Then there's another 6 that your investment becomes $50 in some capacity. There's some kind of an acquisition, and you end up getting half of your money back. So that would be pretty terrible over a 10-year period in any kind of investment vehicle. So if you had 18 investments, so far you're not doing so good. But then there's another 4 companies that you actually broke even. So the company was able to kind of stagger along, and they didn't fail, but they didn't really blow up either. And 10 years later, you basically got your money back, and that's for 4 companies. So again, if we take a look at 22 companies in, or maybe we call this 2 or so, the numbers here aren't looking very good for this investment. And I think the math is a little fuzzy here. Maybe it was $80 you invested per company, but stick with me on this. And then 3 of these investments actually 5x. So you had, out of 24 investments, you had 3 investments actually do pretty darn well over a 10-year period. I mean, you can find companies in the public market that will 5x over 10 years, but in general, that's doing really, really well. And then you have 1 company out of your 24 in your portfolio that absolutely just skyrocketed. It really blew up. You invested in something like a Shopify. You invested in something, a Facebook actually would be bigger than that kind of a return on investment. But basically anywhere from a 20 to 100x return on investment over 10 years. If we're talking these hot companies like Amazon, add a 0 to that. We're talking 1,000x return over that time frame. So in your 24 companies, half fail, half of them return something, but really only a handful and really only 1 actually kind of outbalance. And it's really important to diversify your portfolio. So you're not investing $2,400 in 1 company, but just to go the math, so that $2,400 could theoretically become $12,200 in this example. Okay, now the numbers are rough, it's just an estimate. If you were to invest that $2,400 in an S&P index fund that follows the S&P 500, that has historically returned 8 to 9% over the last 100 years or so, accounting for inflation, if you were to see that 6% compounded growth, you would have $4,200. So you would close to double your money in that 10-year window. That's pretty good. Not as good as $12,000, but okay, you know what? $10,000 is maybe that's a little unrealistic to expect a 100x return in your portfolio of 24 companies. If you pick good companies, that's actually not an unrealistic potential return. But you know what? Let's call it 20x return. Instead of 100x, you have a big winner, but it's not a superstar. It's just a big winner. We're going to give it 20x return. So that $100 would end up being around $2,000, in which case you would have returned about $4,200. So you're about in line with the public investment. And you had the opportunity to invest in a lot of interesting different companies. You probably learned a lot about a lot of different industries, and you were making a more immediate impact in the economy, and you did just as good. So obviously this is a lot more work to invest in 24 different companies, but you're gonna learn a lot in the process, and you do have the potential to make 5 or 10 times as much as you could in the public account. I hope this video was super valuable. If it was, make sure you like it and let me know in the comments how you're going to be investing your different stimulus checks that you may or may not have received. I'm really curious to know. Let me know in the comments. If you want to see more videos like this, let me know also in the comments. I appreciate your time. Thank you so much for watching. Make sure you're subscribed, and again, like this video. I'll see you guys next time. Keep hustling.